Central bankers head to U.S. mountains with a horrific case of inflation reflux. London, Frankfurt. This time final 12 months, the sector's biggest imperative banks had been united in getting the inflation story wrong. Now, as pinnacle policymakers gather for the Kansas City Federal Reserve's annual Economic Policy Convention in Jackson Hole, Wyoming, the U.S. principal bank looks as if it would manipulate a smooth touchdown for its very own economy. However, the outlook for Europe is far more traumatic. Much of the arena is going through the fastest charge boom since the early 80s, raising fears of a repeat of that era's wage-price spiral phenomenon that required double-digit interest quotes and painful recessions to restore rate stability. That leaves some of the principal bankers heading to the Grand Teton Mountains this week, hoping modern-day inflation pressures will bog down quickly enough to permit them to counter the downturns predicted in economies round the arena. They are stuck between a coming recession and sky-high inflation. Their first situation is to react to excessive inflation, said Holger Schmieding, leader economist at Berenberg. Once the recession is clearly there, the priority will shift. That shift, although, should well be asymmetric, with the Federal Reserve specifically signaling an unwillingness to quick reverse gears. Last year at the moment, for example, Fed Chair Jerome Powell asserted that the jump in inflation might probably be transitory. As that narrative unraveled, he have become the using force at the back of the fastest pace of U.S. economic tightening in many years. Moreover, he and others at the U.S. Critical Bank have additionally indicated a willingness to tolerate a measure of contraction within the American economy if that's what is wanted to tame inflation. While there are some indicators the Fed may additionally quickly dial down its fee hikes from the 75 basis point tempo at its last two coverage conferences, Powell may additionally use his keynote speech to the symposium on Friday to chill expectations among buyers of cuts to borrowing charges in 2023. Powell will likely try to strain a slower pace of hikes, however also a longer period of time in restrictive territory, taking a touch wind out of the sail for the dovish pivot narrative, mentioned Jack Janasevich, lead portfolio strategist at Natixis Investment Managers Solutions. Won't vanish quickly. U.S. purchaser price inflation fell, however, was nevertheless at almost a 40-year high of 8.5% in July, down from 9.1% within the prior month, and is predicted to come in nearly 4% in 2023, in keeping with analysts polled through. The outlook is starkly worse in energy importing Europe, in which Russia's invasion of Ukraine has brought about skyrocketing energy costs that look set to maintain on accelerating as Moscow retaliates in opposition to European sanctions with the aid of proscribing gas flows. Euro sector charge growth is now set to hit double digits as measures taken with the aid of Germany and different international locations to melt the cost of living hit for consumers begin to expire, the Bundesbank warned this week. European Central Bank forecasts display Eurozone inflation will fall to a few 0.5% in 2023, but its figures had been regularly revised up and Germany now expects inflation above 6%, suggesting the ECB's subsequent forecasts in September will move higher. These inflationary pressures are in all likelihood to be with us for a while, Isabel Schnabel, an ECB board member who will talk at the Jackson Hole Symposium, mentioned in an interview Ultimate Week. They might not vanish quick.